Child, nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. JP Morgan once said millionaires don't need astrologers, but billionaires do, and so we began. Today is Wednesday, May 29th, 2024. Friday this week, we have very important PCE data coming out today. Now, finally, the professional traders are back, and I was excited to see what happened today, and a lot happened today. Markets are finally getting a little exciting. I'd like to start today with the most boring chart, the daily S&P 500. We closed basically at the bottom of this engulfing red candle here, and so, it's acting as support right now. We didn't really break through it. Right now, this is considered to be consolidating. We're moving sideways. This can break out higher, but the more likely scenario is for it to break down lower. Similarly, in the Qs and the NASDAQ by itself, this is consolidating sideways. Again, a large part of this is the weight of NVIDIA, as Gareth Soloway on his shows has been talking about. Without that one stock, these would both be actually already quite negative, and this is obvious when we take a look at the Dow Jones, which has been really looking like it's falling off of a cliff here since May 17th. Looks like we hit a peak over that was the day, remember, the Dow hit over 40,000. We closed over 40,000, and a lot of times that acts as a support level, and it can keep going up from there, but instead it acted as a absolute top here. And in fact, pattern wise, what I'm seeing here is a double top. So that's when you have a top and then you have a low somewhere and then a similar top. And so this is a one top, two top. Now the way this pattern works is that if we break the low of this M pattern, that we can go significantly lower from here, and that's what it looks like it wants to do. It looks like it's going straight there, and I don't even know if it's going to bother even pausing at this line at all, but we'll see. I've been talking about HYT breaking down here, ever since this wedge pattern. We had this big engulfing candle. I said that was looking very bearish. We have been holding this support line for a little bit, and then we broke through it, and so this looks like it wants to go down at least to the bottom of this. Like I said before, the three black crows that looked weak there, maybe this is it. Maybe HYT is going to take go down here, but one thing to be careful of, I'm not nowhere near thinking about shorting HYT right now. It's just keeping an eye on it. One thing to important is the credit spread between the Treasury guaranteed yields and the high corporate yield. And so the higher the risk, when higher risky things have less risk perceived, then the yields are allowed to shrink. And when the perceived danger goes up, when the risk is going up, the credit can spread, but they will go with each other. And in treasuries today, we saw a pretty big jump in yields, especially in the 10-year, and so that's going to automatically push the value of high yield corporate down. And so high yield corporate is not exactly breaking here, not right now, not yet. When looking at the 10-year note treasury yield, I've been talking forever about this trend line and how we broke through it, and did we confirm it? Oh, it never got confirmed. So this candle, we never closed actually below that candle there, but I talked to you just yesterday how we kissed this line, and I thought we were going to be going straight down from here. Instead, we broke right through this, so I'm very curious to see what will happen from here. If we grab a parallel line from here, what's going on? Well, it's more obvious in the 30-year. Never mind. Here's the 30-year treasury yield. I did a parallel on this one to see like where is this one hitting, and it looks like we do have a trend line here where it hit, and so the 30-year could have resistance here. I guess Supposedly the 7-year and 5-year bond auctions didn't go as well as planned, and that adds yield into the longer, um, term securities. Gareth on his show today mentioned how uh, it's a fear of investing in treasuries, and that, like, that people are just they need a higher yield in order to invest in treasuries. I do not think that's what's going on here at all. I think there might be a little bit of killing the last bears in the bond market. Again, I'm bullish on bonds here. And well, the other main thing is the fear of inflation. And so, the real truth comes out on Friday. And if the PCE data comes on like super, super hot, yes, yields on the long end will likely rise. If they're not super hot, I don't see yields continuing to rise here. But that's just me. That trend line, but yeah, in the 30-year, we just hit the middle of what looks like this channel. And you can see we've had several points hitting this line before, and so this could be a top here in the yields. I really don't know. One of the other reasons I don't think people are running away from the dollar is because the dollar went up today. How can you say people don't want, people need a higher yield on the dollar? And it's kind of like a mistrust of the dollar itself, when the dollar itself is actually increasing in value today. And so, it's a little bit of like, a lot of people got hurt by bonds pretty bad, especially during the pandemic when rates went so incredibly low. Banks were buying them. Banks have psychology too. Banks got hurt big time by the value of their bonds dropping significantly. And so I think there's going to be residual pain, left until people realize that these historically high rates are not likely, pretty much guaranteed to not be sustainable. I don't think they can keep going up from here. We don't have the demographics. That's the main thing here. And we don't have the growing demand. It's quite the opposite, and that's evident in all of the data. But I digress. One of the other big indicators I like to take a look at that I've mentioned in shows not for a while is wood, the price of wood. And wood really took a leg down today. So, I mean, to my eye, it looks like it wants to keep heading down here. On the Fear and Greed Index, yesterday we were neutral at 52. We're dropping down to 47. So we are headed more and more into the fear zone. It does look to me like we're going to be going further in that direction. And, this is the thing, when the markets get really fearful and stocks start really selling off, treasuries, they hold their ground, and they usually attract a lot of money going into it, out of stocks and into bonds. And you get that run to safety. And yeah, again, I expect to see that coming. Last two things for today I wanted to share was Salesforce CRM down about 17% today, and UiPath down 30% in aftermarket hours. It's getting closer to its all-time lows here. So, it's just, this is just a tribute to, like, how can you possibly be surprised? The earnings per share of UiPath are negative 16 cents a share. How do you value that? CRM, the current PE ratio is, $64 and no, sorry, 64.5 is the PE ratio there. How can you determine whether it should be 64 or 164 or 3,000? It's trading like a penny stock, and it's anytime a PE ratio, especially, is like above like 25, it's like it's gambling, in my opinion, and it trades like a penny stock. And I mean, if for investors interested in these kinds of things, it has to be done with either you have to be a really good trader and see things coming and have a crystal ball like me, um, or you have to see it as a longer term investment and you don't care if it drops 20% or 30% in one day, because your goal is to hold it for the next 10 years, where it's gonna you believe in the company, say, and that its earnings are going to be multiplied by 100 by then. And so but for now, these stocks are trading like penny stocks. And yeah, interesting, exciting stuff going on. Again, for me, nothing really happens till this Friday, and the biggest piece of data for me personally is the unemployment report, not this Friday, the following Friday. Are we breaking higher from 3.9%? Are we ticking down just a little bit, showing that, yeah, unemployment is starting to become an obvious problem still, even if it ticks down? Or is it going to plummet, and then the economy is so hot that it becomes obvious we're going to be needing to raise rates again, and more fear of inflation starts to set in? We'll see. And that's all I have for you today. Hope you enjoyed. Thank you for watching. Rob's Child.